Welcome back to another explainer. Look, if you've ever felt completely overwhelmed by the stock market, you are absolutely in the right place today. We're going to cut right through the noise and demystify one of the biggest myths in modern finance. No flashy gimmicks, no complicated charts. We're just going to look at the clear, undeniable math of a totally passive strategy that actually builds long-term wealth.
See, here's the thing. There's a massive financial industry out there that literally profits off your confusion. They desperately want you to believe that investing is this exhausting, high-stakes game of chess, right? Like you need to be glued to the 24/7 news cycle and hand all your money over to some expensive advisor. But the truth? The most successful strategy out there actually requires doing remarkably less. We're talking about a passive investing routine that takes maybe 10 minutes a year to manage. Okay, let's run through today's roadmap real quick. We've got 5 steps. 1. The Wall Street lie. 2. The index fund advantage. 3. The two-click portfolio. 4. Dollar cost averaging. And 5. The psychology of wealth. Let's get into it.
Starting off with part 1, the Wall Street lie.
First off, it's totally normal to feel anxious about investing. If you've ever been paralyzed by all that financial jargon or those panic-inducing headlines, I completely get it. But you have to realize you were designed to be confused by a system that is literally selling you stress. The industry needs you to think you have to constantly monitor charts to win, just to justify their own existence. Once you realize all that complexity is completely manufactured, well, that's when you take your power back. All right, moving right along to part 2, the index fund advantage. So what's the actual fix here? It's a concept called passive index investing, and it is a real game changer. Think of it like a giant basket. Instead of putting all your money into just one company, inside this basket is a tiny slice of the biggest companies in the country. You're getting Apple, Amazon, Microsoft, and hundreds of others all bundled up together. You don't need to be some hotshot financial analyst picking the absolute perfect company. With one single purchase, you're buying into all of them at once. Think about it this way. When you buy an individual stock, you're betting on one single horse to win the race. If that horse trips, you lose your money. But when you buy an index fund, you aren't betting on a horse at all. You're betting on the entire track. You own the whole race. It just perfectly highlights how dangerous individual stocks are compared to the incredible safety of owning the entire economic ecosystem. There's this fantastic quote popularized by investing legends that hits the nail on the head. Instead of trying to find the needle in the haystack, buy the whole haystack. I mean, why spend hours agonizing over which single stock is going to be the next big thing? Buying the whole haystack means you capture the overall growth of the entire market, totally eliminating the catastrophic risk of picking the wrong stock. So what does buying that haystack actually get you? Historically, it's about 10%. That's the long-term annual return of the stock market. Now, obviously, it doesn't go up exactly 10% every single year like clockwork. Some years it's up 20%, some years it's down 10%, but over the long haul, it averages out to 10% annually. And this strategy reliably captures those returns while you're literally sleeping.
Which brings us to part 3, the two-click portfolio.
Let's look at exactly how to execute this. Depending on how unbelievably simple you want to make your life, you've basically got 2 options. Option A is the one-click method. You buy a fund with the ticker symbol VT, which stands for Total World Stock. Boom, one click, and you own nearly every publicly traded company on Earth. Or you can go with option B, the two-click method. You buy a US fund like VTI and an international fund like VXUS. This just gives you a little bit more control over how much of your money stays domestic versus going overseas. Honestly, both are absolutely brilliant. Now, you might be wondering about the cost. What's absolutely crucial to understand here is the math behind the fees. Both of those index options cost less than 0.05%. So for every $10,000 you invest, you're paying like $5 a year. But a high-priced advisor, they'll often charge a 1% fee. And sure, 1% sounds tiny, right? It's not. Over a lifetime of investing, compound interest works against you, and that 1% fee will quietly eat up to 30% of your total lifetime wealth. It is literally destructive to your financial future. All right, let's hit part 4, dollar cost averaging. This right here is the ultimate stress-free maintenance phase. One of the biggest mistakes people make is trying to time the market, waiting for a crash to buy low, or waiting out a bull market because they're terrified. It's a hugely flawed, anxiety-inducing way to live. The winning strategy? It's called dollar cost averaging. You completely ignore the news, and you just automate a transfer from your bank. Maybe it's $100, maybe it's $1,000, but you buy on the exact same day every single month, no matter what the market is doing.
Here's why this is so brilliant. When the market is up, your money buys fewer shares. But when the market crashes, well, your automated transfer suddenly acts like a giant coupon. Because prices dropped, your exact same $100 buys way more shares while they're on sale. You're turning terrifying market dips into automatic bargain hunting. You don't have to be a genius, you just have to be a robot. Consistency is going to beat intensity every single time.
And that leads us to our final step, Part 5, the psychology of wealth. I gotta warn you, we are now entering the absolute hardest phase of this whole thing, the mental game. Because you're probably asking yourself, if this strategy is so simple, why isn't everyone walking around as a millionaire? Well, the truth is, simple is definitely not the same thing as easy. The math is simple, for sure, but human emotion? Not so much. The incredibly difficult part of all this isn't logging in and buying the fund. The hard part is doing absolutely nothing when the television is screaming at you that the economy is collapsing. This whole strategy requires stoic discipline. You have to actively train your brain to go against its own survival instincts and completely ignore the chaotic panic of the 24-hour news cycle. Just keep this vivid analogy in mind. Your portfolio is like a bar of soap. The more you touch it, the smaller it gets. Every single time you log in to tinker with it or sell out of fear or try to somehow outsmart the market, you're just eroding your own wealth. You end up paying fees, paying taxes, and making the absolute wrong move at the wrong time. You just have to leave it alone to grow. So honestly, you kind of have to be okay with being a little bit boring. Building real wealth is completely unglamorous. You're not going to be the person at the dinner party with some thrilling day trading story or a hot stock tip. You're just going to be the person with a steadily growing, unshakable mountain of wealth. And frankly, that's a trade-off we should all happily make. So let's bring this all together into your exact action plan. Here's your homework. Step 1, open an account at a reputable place like Fidelity, Vanguard, or Schwab. Step 2, pick a total market index fund like VT or VTI. Step 3, set up that automatic monthly contribution. And step 4, honestly the most important one, go live your life. Focus on your career, your family, your hobbies, and let the biggest companies in the world do all the hard work for you while you sleep. I want to leave you with this final provocative thought. Wealth isn't built by being the smartest person in the room. It is built by being the most disciplined person in the room. You've got the blueprint now. The whole mystery is totally gone. So the only question left is, are you ready to rely on discipline, stop gambling your future away, and actually start investing today? Thanks so much for joining me on this explainer. Get out there, execute the plan, stay the course, and I'll catch you in the next one.